Hello and welcome to another episode of Darwin Investors. We had a great day today, and I usually don't do midweek videos, but I just couldn't help myself today. I had to celebrate old Powell, yeah, St. Powell. He came and saved us today and gave us a little bit of a reprieve, something that was actually something to cheer about for a change in this market. I've only been doing this channel since like the beginning of January. I could probably count on my hands the amount of good days we've had. So yeah, I'm going to release this video. And so I'm going to talk about certain things today. So let me go ahead and share my screen. Um, what I'm going to talk about is why stocks soar today and the reason for that. And then we'll get into 4 reasons why it's believed that inflation has actually already peaked. And then I'm going to kind of like make a guess as to when I expect the market to turn around. And that's going to be best based on the Fed funds outlook. And then finally, I'll talk about how I played this market today on this pop. So the reason why the stocks went up today was because Chair Powell took the 75 basis point hike pretty much off the table, at least for now. And there are reasons for this, I believe. I would turn on CNBC today. They're kind of raining on my parade a little bit. But I can see the reasons why he would take this off the table for now. But what had happened was Steve Leisman, he's an analyst on CNBC, asked the question about 25 basis point hikes and 50 point and 75 point point hikes. And this was Chair Powell's response. He said there was a broad sense on the committee that additional 50 basis point increases should be on the table at the next couple of meetings, and that a 75 basis point increase is not something that the committee is actively considering. Now, this sent the markets up in a straight line because a lot of predictions were that the Fed would actually do a 75 basis point hike in June. And he's seemingly taken this off the table. Now, why would he take this off the table? Well, one of the reasons would be that it's believed that inflation is peaking. And, the Fed only has the 2 jobs, control unemployment and control inflation. Unemployment seems to be doing pretty well right now, and inflation is believed maybe has peaked because of a few indicators here. Now, one of the indicators that they're using is their own PCE index. It's their favorite personal consumption index. It excludes food and energy because they tend to be the most volatile. I tend to think food and energy are really important because those are the 2 things you really need to have to live on, but they exclude it from their index with respect to inflation gauge. They say that the PCE index climbed to 5.2% through March, and that reflected a minor deceleration from 5.3% seen in February. Then there's also the Dallas Fed's inflation tracker. The Dallas Fed is interesting because they use this thing called the trimmed mean price index. And what that does is it excludes the wildest price swings from each month and then averages the remaining changes. So they're kind of removing the outliers. This method of calculating inflation aims to look past short-term price drops and surges and instead uncover the fundamental dynamics, either accelerating or cooling price growth. And the March reading for the trimmed mean inflation signals was 3.1%. And it was 4% in February and 6.3% in January. So the Dallas Fed seems to think that inflation actually peaked in January. And now when I think about it, just in my own life, that's what I have to go off of, just anecdotally speaking. I did notice that prices were going up significantly through time for a while there, but I will say that here recently, though they may be going up, it's not as noticeable, or at least I'm not noticing it as much as I had, say, about 4 or 5 months ago. So I do think that it probably is kind of like tailing, just kind of remaining steady at this time. Maybe gasoline is going to go up a little bit later, and we'll get into why I think that's even going to go up higher in just a little bit here. It also shows that Americans are bracing for higher inflation. They're using something here called a surprise index. And what the surprise index is it's how people stock up for stuff. When we anticipate inflation is going to go up, we might go to, say, Costco and stock up on a whole lot of stuff because we think it's going to be way more expensive in a couple of months. And that will pump up what's called the surprise index. You have big companies such as Toll Brothers might stock up on lumber. And they routinely do this. When they see the price of lumber comes down, they'll go buy a whole bunch of it. And then when it goes back up again, they'll already have some on hand, so they're not going to pay those prices. And so the American consumer does something very similar. We go out and we grab stuff at a good price now, and we and don't buy it at a more expensive price. So Citi's U.S. Inflation Surprise Index, which measures the degree to which inflation data surpasses or falls below estimates, has dramatically declined in recent weeks, signaling inflation expectations have already hit their peak. The drop could be a precursor to cooler price growth. And so the last one here is that shipping rates are past their peak. Yet one of the biggest factors roiling supply chains is easing up. Shipping rates have been on the decline since September, and the downtrend has accelerated in recent weeks. It now costs roughly $89.55 to ship a 40-foot container of freight. So that's the lowest since mid-July, and that's down from nearly $10,000 in March. So these four gauges are saying that inflation is actually on the decline. And Etsy came out with earnings today, and like a lot of other companies, they're giving poor guidance. And when you're giving poor guidance now, it's causing your stock to fall. One of the problems is that e-commerce is having a problem selling goods at the moment. Things are slowing down. We saw it with Amazon. We're seeing it here with Etsy. But what Etsy is showing is that in the current macroeconomic environment, consumers have less disposable income and many more places to spend it. And while this creates a short-term headwind for sales in our marketplace, we have very strong conviction in the long-term growth of our potential business. So what they're saying is that people are having less disposable income. And so we've got inflation peaking, less disposable income, companies giving less strong guidance. For all these reasons, there's not a real strong reason to go and hike this thing up 75 basis points, because it looks like things are kind of fixing themselves right now. Now, one thing that could be a headwind for us is the oil prices, because the situation in Ukraine is not fixing itself. There's a big embargo on the Russian oil, and historically, oil prices seem to have an impact on our inflation data. And also we're heading into, we're in May, you're heading into the summer months, and this is the time of year when oil would spike anyway. And so now we're having oil supply problems, and we're heading into the summer months. And what has this done historically? Well, if you look at historically here in 1973, inflation started going up here and went 6.2 to 11% to 9.1% and so on and so forth until it finally got to like 1982 when it got down to 6.2% and then finally down to 3.2%. We've all heard the name Paul Volcker a lot lately, and Volcker came out and hiked up interest rates and squashed all of this inflation. Well, look how many years this went on. It went from 1973 to 1982, and then Volcker had to come in here and fix this. They want Jay Powell to do that like right now, and our inflation has only been going up since last, April? And so he doesn't see the reason to turn the screws so hard because it just hasn't been that long. Let's let this play out a little bit. Let's let this the demand destruction take place. Let's see if we hit peak inflation, and that's how he prefers to engineer a soft landing, although it seems like analysts would like to just put the brakes on and just squash this right away. We'll see who's right. I tend to be on Team Powell because I'm basically not on Team Recession. I think the recession's bad. I am not in favor of it. I think that people should keep their jobs and we should try and engineer a soft landing as humanly possible. That's my side. I'm just officially not on Team Recession. So why did this thing go up in 1973 and then persist for all these years? Well, it had to do with this 1973 oil crisis. And essentially what happened was the United States sent arms to Israel in the fight against Arab nations in general. And they didn't much appreciate that, so they put an oil embargo on the United States. That oil embargo started in 1973. You can see in 1973, that's when inflation started to go up, and it persisted all the way until 1982. So what do we have now? Well, we have an oil supply chain problem going on right now, and we're heading into our summer months. So I'm hopeful that inflation will come down, but historically it seems that high energy prices tend to lead to more inflation. So we'll see what happens. I hope everybody is right, but if the inflation continues to go up, we can expect to see a lot more rate hikes. Now, when do I think that we're actually going to pull out of this? Well, I showed you the Etsy earnings, and one of the reasons why the stock went down so much was it was bad forecast. As a matter of fact, a lot of companies right now are showing that right now that they're having good earnings, but they're forecasting poor earnings. And so the Fed funds target rate, it looks like it says in December 22, we're expected to be at 2.23%. Right now, we've gone up 50 points here and then 25. We're barely under 1 now. And they're expecting it to be up to 2.23% by December. And then we're going to peak in August at 3.08% and then start coming back down. So my feeling is that in about November, when we start reporting all the earnings in November, that they're going to forecast out to here and show that that they're going to give better outlooks than what they've been getting. And though their actual data that they're reporting, maybe they barely beat or even barely miss EPS and revenue, but their guidance will be better because they're saying they're going to expect the fund rate to come down. And that's when I think the market will actually go up. Not when, I don't expect it to go up when this actually starts coming down here in August of 23. I expect it to go up in November of 22 when they start projecting things are going to get better a year out, because that seems to be the way the market is going. So how did I play today's market? Well, here in the comment section of yesterday, I'll never do a Patreon or a Discord or anything like that, but I will answer comments and I will talk about how I'm going to play the market in that way. So it says, I believe, this was from yesterday, I believe Powell will announce the 50 basis rate hike tomorrow and the market will go up for some reason. We'll see. I can't wait to start playing the market again like you are. Right now, I'm holding on to great stock and wasting my time. Although if it does get a nice pop tomorrow on the Powell announcement, I'm going to be selling a lot of covered calls. Also, I think we both have AMD and they rocked earnings. It looks like tomorrow will be a really good day to sell way out of the money covered calls, and that's on AMD, and that's what I did. So the market opened today, and then I went ahead and sold a covered call for $104 on AMD. And then about a half hour later, I bought it back for $55 as things kept coming down. Anytime after earnings and these companies get this huge pop, the one thing that you can do is first thing in the morning the next day, just hurry up and sell a covered call. And then it's going to spike up and then it's going to crash. And then when it crashes, buy your covered call back. And then what you can do is later in the day, like right here, like right at the end, I sold another one. So I sold it, then I bought it back, and then I sold another covered call right before close because I was hoping that after Chair Powell spoke that the market would pop and then I would sell all these covered calls, like I said in my comments there. And so let's just look at what I did here. So UPS, these expire on the 13th of May. With a $192.50 strike. So I'm selling it pretty far out of the money, meaning at the money, if it's like, let's say it's $181 right now, I don't know what it is, but at the money would be 181, in the money would be 178, and way out of the money would be 192.50 like I did here. So an out of the money covered call that expires on May 13th, and I collected $39 in premium. Now, you're not going to get a lot of premium selling things far out of the money, and I don't really care. I don't go for the high returns on these premiums. What I want to do is keep my stock and their money. And so I'll sell it far out of the money and I'll sell it for less price. So I did AMD with a $110 strike. This was after I sold one and then bought it back with a $105 strike. I came back later in the day, did a $110 strike, got $48 for that. Got $62 for Lowe's at $220. And all of these expire on the 13th of May. JP Morgan, $132 strike, got $68 for that. And NVIDIA, $230 strike that expires next week for $84. And all told, $361. Now, how do I play these covered calls? Am I actually going to let them run all the way to expiration and collect all $361? No, I'm not. If tomorrow's a really awful day, and I hope it isn't, but if tomorrow's a really awful day and I can collect $150 and I only had to hold all these contracts for one day, I'll do it. And so that's how I get in and out of these call situations, or out of these option situations. I tend to do it quickly and I take my profits fast. You don't want to cap your upside too much by selling too many of these covered calls and holding them to the end. There are times when I would like sell a covered call and I'd be up, say 50%, only to end up down 400%. So you don't want to hold on to them too long. Take your profits. That's what these are for. And so that's how I play the market on earnings, and that's how I play the market on really good days. All right, that's all I got for this Wednesday. If you got anything out of this video, yeah, please like, subscribe, leave comments. I will actually engage in that way, and we can discuss what you think about different market strategies and what you have going on. And I'll offer my 2 cents. I'm not a financial advisor. I just tell you what I would do. Anyway, thanks for checking out the channel, and we'll see you next time. Bye.